Let's try and talk about the macro that we're all focused on while balancing it with some options flows with Mr. Cem Karsan, Senior Managing Partner at Kai Volatility Advisors, back with us here in studio. Cem, so let's firstly talk about the options situation, because that's what we spend a lot of our time discussing. It seems like from last time we spoke, we kind of like somehow threaded this needle, because we spent time talking about this whirlpool that was in the market, and it seems like we're stuck.
Yeah, when we were here last, we talked about Feb 15th to 17th, right, being a near-term top. That's what we got. We didn't get at first, what felt like a liquidation. Narrative follows price. Now, all of a sudden, there's kind of a tail appearing, and there's more fear here. That's kind of how these things work, right? This is March OPEX coming up. It's a quarterly OPEX. That matters. Why does that matter? There's more put positioning. There's more structured products tied to this March OPEX. There's more skew broadly in the market. Dealers are short put, long call, and particularly in certain parts of the market. I heard somebody earlier come on and talk about how tech has been outperforming Russell. That's been a major player this week. Not a coincidence that it's happening this week. All of the put positioning, the grand majority of it has been in tech. It's been well documented. I've talked about it for a while. As you approach OPEX, that put positioning that dealers are short is natural Vanna Charm buyback that happens exactly in this window. That's been incredibly supportive for the tech sector while positioning has been quite weak, especially after all the kind of negative flow we've seen for all this time. There's a lot of value in the Russell that isn't real value, that is really susceptible into a real liquidation, particularly
from a credit perspective.
From a credit perspective, absolutely. Value is not, that term is obviously not always what you think it is. That doesn't mean high discounted cash flows over the long run. There might be a lot of problems when interest rates goes higher and these companies can't refinance. So that's the macro perspective, but that stuff went up and a value growth rotation due to flows for quite some time, and now you're seeing the readjustment now that the positioning has gone the other way on the boat. So that decay from the NASDAQ has really been a defining force in this massive trade, tech versus Russell.
Right now, it seems the market's still very myopic about what the Fed is going to do, that this is really all that matters to these companies. Or do they go 25, do they go 50? As soon as there was a whiff that the Fed could drop some of that aggression, we saw this high valuation growth trade come back. Are we getting to the point, though, where that will run into a wall if the underlying situation deteriorates enough?
It's frustrating for the Fed, right? The Fed came out and this was actually, in my opinion, very well telegraphed. They were out there selling calls. We talked about it, not literally selling calls, out there trying to get the equity market down, to get speculation out of the market, right? This is, I think this was all relatively telegraphed. If you look at the banks that went under, crypto and tech, right? That's what we're looking at. That's where the speculation has been. That's what they want out of the market. So in my opinion, this is something that the Fed actually wanted to an extent from the equity market. The problem is there's
clearing out the froth still.
Clearing out the
We've
froth.
Done tech, consumer, why not banks?
Trying to use the wealth effect, right, to bring down economic growth. The market rallied 20% off the bottom. And we keep getting hot inflation numbers and keep getting more and more speculation. That's exactly what they don't want, right? Now the problem is, as they do that, and they've been looking to pause, by the way. Why do they want to pause? Because there's a lack of clarity at this point. It's been 5%, 4.75% move in interest rates with very little pause. And we just don't know there's a lag. We just don't know what's going on yet. So they've wanted to pause. The problem is the word pause is read as pivot. It leads to a 20% rally in market, which makes things hotter. And it's a really tough situation, right? So the Fed has been selling calls, trying to dampen the upside, remove the speculation. It's worked, right? And they've done that by talking yields, up. The problem is now that we're getting this liquidation in the short term, we've seen an overreaction by the bond market. Dramatic reaction. And the Fed does not want the long end of the curve coming down like it has. So expect that now. The headwind is actually, in my opinion, not this bank story that you're hearing about. This is not 2008. There's always a tail in banks, as you mentioned. That exists. You can't get rid of that. But the real story is that rates have to go higher. Yields have to go higher at the end of the curve, the back of the curve, while equities go down.
And that's a hard combination. This week, will they surprise next week?
I do. I think. It's going to be a quarter. I don't think they're going to come in and try and shake the boat, but I think Powell's going to try and talk up the yields in the back end of the curve. This is not what they want. They do not want the long end of the curve coming down and stimulating. I mean, just today we had housing starts come in super hot. Yeah. 24% year over year in multifamily investment. I mean, What do you think happens now that the yields along the curve have come down by as much as
Mortgage
they
gaps
have?
are going to boom next week,
Exactly.
right?
So this is not what the Fed wants, right? From an inflationary perspective, it's not a problem. But they do want the equity market down, the froth out. So they got that part. Now they got to try and thread the needle again and raise kind of yields in the back end of the curve. So I would expect some of that. I think that's the next headwind that faces the market. The Fed is still selling calls that, don't fight the Fed. The Fed sold puts for forever, right? In the short term you may win, but in the long end you're going to get bled out.
Thinking about over this next couple of weeks here, the next month or so, as you like to think about things in kind of month chunks, it seems like there is a level right now in the S&P that we've kind of been, it feels like we kind of keep going around. We keep talking about these same areas. It's like this market can't get too far from 4,000. Is that still basically the kind of line in the sand over the next month?
One thing we said last time is knowledge is vol dampening, right? And the reality is the more people kind of understand the positioning, understand the structural dynamics, the more it dampens volatility. This was a window for there to be liquidation. People were broadly prepared for it. Yes, we got a decline. Yes, we got some bank issues. But for the most part, people are well positioned. And because of that, as you reach OPEX, you get buyback of stock and all these things we've talked about. So stair steps is still the name of the game. There is a secular headwind. Again, the Fed is selling calls. They don't want the froth in the market. They will continue to take it out if it rallies back.
Yeah.
That doesn't mean you're not going to get rallies back because people are short, because hedging is out there, and it's by definition liquidations can't happen when people are prepared for it.
Okay. A very macro Cem Karsan today. All right, I like it. Appreciate it.
Great.
Always
Thanks.
a pleasure.
Thanks for being here. Thanks for
Cem
having me.
Karsan, Senior Managing Partner at Kai Volatility Advisors. Looking for 25 bips next week, and a Fed that still wants to keep that yield curve as afloat as possible.